Here's a number no teacher ever wrote on a whiteboard for you. Since 1960, 85% of the stock market's entire return came from one thing. And it wasn't stock picking or some hedge fund secret. It was reinvested dividends. That's research from Hartford Funds, and the gap it creates is almost rude. $10,000 put into the S&P 500 back in 1960 grew to roughly $982,000 on price alone. The same $10,000 with dividends reinvested came out around $6.4 million. Same money, same index, same years. The difference was a mechanism schools never mentioned, and they knew. 30 states now force high schoolers to take a personal finance class before they graduate. In 2020, it was 8. They fixed it for the kids behind you. Nobody came back for you. So today I'm fixing that. 5 monthly paychecks, $100, $500, $1,000, $3,000, and $5,000 a month. And the exact portfolio size that pays each one. Plus the piece of math that moves your finish line closer every single year. If it's ever felt like everyone else got a money manual you never received, stay with me. By the end, you'll have the whole blueprint, napkin included. School trained you to show up, trade hours, and collect a paycheck someone else signs. 12 years of preparation to be on a payroll, and not one afternoon on how to build your own. That gap isn't theoretical. Northwestern Mutual's 2026 Planning and Progress study asked 4,375 American adults about retirement. 48% said it's likely they'll outlive their savings. Almost half the country quietly planning to run out. Here's what makes me genuinely angry. The fix was never complicated or gated behind a finance degree. The wealthy have used it forever, in plain sight, while the rest of us were taught that income only comes from effort. It doesn't. Income also comes from ownership. So let me hand you the rule they skipped. Every share you own is a tiny employee. One share of a dividend-paying fund is a worker on your payroll, except this payroll runs backward. They pay you. Every 90 days, each one slides a few dollars across the table. No meetings, no commute, and they never call in sick or quit. A dividend is a company splitting its profit with its owners. You can pocket that cash or do what the wealthy do and flip on a DRIP, a dividend reinvestment plan. Now, every payment automatically buys more shares. Your employees recruit new employees. The new ones recruit more. That recruiting loop, left alone for decades, is where the 85% figure comes from, which flips the only question that matters. Most people ask how much they'll have someday. An owner asks it backward. What monthly paycheck do I want, and how many employees does that take? The napkin math. A broad dividend portfolio today pays out around 3.5 to 4% a year. Use 4 to keep it clean. Take the yearly income you want, divide by 0.04, and that's your portfolio. That's the whole formula nobody handed you. Let's build your first paycheck. $100 a month is $1,200 a year. Divide by 0.04, and your number is $30,000. $30,000 invested, and your tiny workforce covers your phone bill and your streaming for life. I know, 30 grand sounds like a mountain from zero. So here's the honest timeline, not a fantasy. At roughly 8% average yearly growth with dividends reinvested, deliberately below the market's long-run average, $300 a month gets you there in about 6.5 years. $500 a month, just over 4. Slow is fine. Slow that compounds beats fast, that doesn't exist. Where this money goes matters more than beginners think. Write down this order. First, keep 1 month of expenses in a high-yield savings account, a HYSA. That's your buffer, so a flat tire never forces you to sell shares. Second, if your job's 401k matches contributions, grab every matched dollar. That's a 100% instant return. Skipping it leaves salary on the desk. Third, open a Roth IRA and buy a broad dividend ETF inside it. One fund holding about 100 companies, so one bad business can't fire your whole workforce. Fourth, anything past the Roth's yearly cap, around $7,500 in 2026, goes into a regular brokerage account. It's a boring list, but the order is what changes lives. Paycheck 1 is honestly the hardest you'll ever build because you're running on belief alone. The next tier turns belief into the evidence. $6,000 a year. Divide by 0.04 and you get $150,000. At this tier, your employees cover the car insurance, the electric bill, the gas, the internet, the recurring drains handled by money you already finished earning. Same honest math. $500 a month reaches $150,000 in roughly 14 years. $800 a month, about 10. Notice something sneaky there. The second $30,000 arrives faster than the first because your workforce now recruits alongside you. Your contribution stopped being the only builder on site. Something else starts here that almost nobody making these videos mentions. Your employees negotiate raises. Healthy dividend companies have a habit of increasing their payout most years, year after year. The largest U.S. dividend ETF has raised its payout by roughly 9 to 11% a year over the past decade. Hold that thought because a moment is coming at the higher tiers where that little fact detonates. For now, just feel the position change. At $150,000, opening your brokerage app stops spiking your pulse. Checking the balance turns into the good kind of curiosity, the kind you used to reserve for tracking a package. $12,000 a year. Your number. $300,000. $1,000 a month is most of the rent in plenty of American towns, or groceries plus utilities almost anywhere. At $1,000 a month, you could survive a layoff without panic applying to anything in week 1. Getting there takes $1,000 a month for about 14 years, or $500 for about 20. Long roads, but you're walking those years anyway. The only question is whether a workforce is waiting at the end. Right around this tier, temptation shows up wearing a suit. Somebody, a coworker, a cousin, a guy on the internet, shows you a fund yielding 12%. Triple your income tonight. Here's how an owner reads that offer. A 12% yield is usually a job posting from a dying company. The payout looks huge because the share price already collapsed and the market is pricing in a cut. You'd be hiring employees from a business that can't make payroll. The screen for it takes 10 seconds. Pull up the 5-year price chart. If the price has been bleeding while the yield grew, that yield is a warning label, not a gift. Your boring 3.5 to 4% workforce from profitable companies will out-earn the flashy one over a decade, and you'll sleep through every market tantrum while it happens. Stay boring. Because at the next tier, boring starts rewriting your taxes, and right after that, I'll show you the math that made me rethink this whole strategy. $36,000 a year. Your number, $900,000. $3,000 a month is a full livable baseline in most of the country. Rent or mortgage, food, insurance, lights. The existence bill paid by ownership. The build. $1,500 a month for about 20 years, or $2,000 for about 17. Yes, those are real decades. They were going to pass anyway. Here's where this tier gets genuinely unfair, in your favor. The IRS sorts dividends from established U.S. companies held long enough into a category called qualified dividends, and qualified dividends get capital gains rates instead of paycheck rates. For 2026, under IRS Revenue Procedure 2025-32, a single filer pays 0% federal tax on qualified dividends until taxable income passes $49,450. Married filing jointly, $98,900. And that's taxable income counted after your standard deduction, so the real tax-free ceiling sits even higher. Read that again. Your $36,000 a year from this tier, if it's your main income, carries a federal tax bill of $0. Your neighbor earns the same $36,000 at a job and loses thousands of it before it ever lands. School taught you how wages are taxed by handing you a W-2. Nobody mentioned the owners were playing under different rules. And the dividends inside that Roth IRA you opened back at Tier 1? Those aren't merely taxed at a lower rate. They're never federally taxed at all. Quick honesty note, I'm an educator, not your tax advisor. And brackets move every year. The structure, where owners keep more than earners, doesn't. Stop, because before the last paycheck, you need to see the thing that changes all of this. Every number so far assumed your yield stays frozen at 4% forever. That's how everyone teaches this. It's wrong. Remember the raises? Watch what they actually do. Say you buy in at a 3.5% yield. Your companies raise their payouts around 9% a year, which, by the rule of 72, doubles the dividend in roughly 8 years. You bought a 3.5% paycheck. 8 years later, those same shares, without a single share added, are paying about 7% on every dollar you originally put in. This is real, not theory. Investors who bought the biggest U.S. dividend, ETF, in 2020 are collecting close to a 6% yield on their original cost today. That took 6 years. The payout on their money nearly doubled, and they did nothing to earn it. Sit with what that means. You don't actually need the full $1.5 million if you can wait. The portfolio you buy is not the portfolio you'll own. Your employees promote themselves. The finish line walks toward you. The day that clicked for me, this stopped feeling like saving and started feeling like an unfair advantage that had been sitting in public the whole time. $60,000 a year. At a 4% yield, your number is $1.5 million. That figure should sound familiar. Northwestern Mutual's 2026 study asked Americans what they need to retire comfortably, and the national answer was $1.46 million. So this tier isn't fantasy. It sits, almost to the dollar, on the country's official finish line, except yours pays $5,000 a month without selling a single share. That's the part most people miss. The famous 4% retirement rule means selling pieces of your portfolio every year and hoping it lasts 3 decades. A dividend paycheck arrives while the workforce stays intact, and the raises keep coming. The long build looks like this: $1,000 a month, reinvested at that same conservative 8%, lands around $1.5 million in roughly 30 years. Start at 25, done by 55. With raises, you now know how to count. Every extra 100 you add is another employee who never stops working. But honestly, the paycheck is the smaller prize. The bigger one is who you turn into while building it. Somewhere around Tier 2, you become a person who checks their account out of curiosity instead of fear. By Tier 3, you sit differently in meetings. Not arrogant, just undesperate because a layoff lost its teeth. You stop performing wealth for people and start quietly owning it. Your account becomes a roster of workers earning for you instead of a receipt for things you bought. Nobody can see it from the outside, and your car doesn't announce it. But you'll know, every time a bill arrives and a dividend already covered it, that you're no longer only an employee. You're an employer now. The system trained you for one side of the payroll, and you hired yourself onto the other. And look, if you own even one dividend-paying share with the DREP switched on, you're already ahead of the curve. Northwestern Mutual found 23% of people with retirement savings have a year of income or less put away. Your first $30,000 tier beats the starting line most adults are still standing on. Full honesty, though. Dividends get cut in recessions. Prices fall, sometimes for years. The 4% yield is planning math, not a promise. And none of this is financial advice. It's the education you should have gotten at 17. The math doesn't need to be perfect to work. It needs you to start and refuse to stop. So tell me your number. Which paycheck are you building first? The 100, the 500, the 1,000? Drop it in the comments. I read everyone, and watching this community's numbers climb is my favorite part. And if school never taught you any of this, subscribe, because I'm teaching the entire curriculum they skipped, one video at a time. Your tiny employees are waiting to be hired. Go hire the first one this week.